Hey y'all, Reese here from Finder.com. Today we're chatting about invoice financing, which is a fast alternative to a traditional business loan that's available even if you have bad credit. At its core, invoice financing is an advance, but rather than being an advance on future sales, like merchant cash advances, it's an advance on outstanding invoices. Outstanding invoices can create cash flow gaps, and invoice financing helps you fill those so you can cover overhead and payroll costs while you wait to get paid. Typically, invoice financing relies on the credit of your clients rather than your own, and unpaid invoices are all the collateral you need, so you won't have as long of an application. But, like other types of advances, it's more expensive than traditional business financing options. There are three main types of invoice financing: traditional invoice financing, invoice factoring, and an accounts receivable line of credit. The first is what we've already described, an advance on outstanding invoices. Traditional invoice financing can be up to 100% of your invoices due. When you repay the advance depends on when your customers pay their invoice. This allows you to keep your relationship with your customer and potentially avoid an awkward conversation about how your business is doing. But it does have a downside. If your customers don't make their payments, you're typically still on the hook for repaying the advance. Invoice factoring is a little bit different. Rather than just getting an advance, you actually sell your invoices to the factoring company. It's best to chat with your customers ahead of time to let them know they'll be invoiced by the factoring company, and clear up any potential worry about the state of your business. But you don't get the full amount for what's due. Instead, you usually receive 80 to 95% of the invoice's value. The rest of the amount, minus a fee, is paid once your customer fulfills the invoice. An accounts receivable line of credit is still an advance, but it acts as a recurring source of funds. For every invoice you receive, you're able to withdraw the amount of the invoice from the credit line. That withdrawal is then treated like a short-term loan. When you repay it, there's either a monthly fee or interest added onto the amount. It varies based on the company you borrow from. Each type of invoice financing comes with a slightly different cost. While lines of credit can be the most flexible, they can also end up costing the most. And while factoring gives the option to protect you if your customer ends up not paying, it can also be more costly than invoice financing. Fees for invoice financing are typically 2 to 5% of the unpaid invoice's value per month, and payments are made on a weekly or monthly basis. Invoice factoring comes with what's called a factor rate and other fees. These usually total 3 to 15% of the invoice's value. For accounts receivable lines of credit, interest and fees start around 4%, but can go as high as 60% APR. If you can manage a longer application and meet the credit requirements, it might be worth going after a standard business loan instead of one of these higher cost options. The exact application you fill out will depend on the lender and type of invoice financing you go for, but the basic steps will likely be the same regardless. First on the list is comparing providers. Make sure you find a good fit that offers the amount of financing you need at a good rate or fee. Second is to complete the application. You'll need to upload supporting documents, which can include a state-issued ID, recent bank statements, a voided check, and info about your unpaid invoices. Third, connect your accounts receivable software or upload the receivables. Depending on the provider, you may have to connect your accounting software or link your bank account. If you agree with the terms you're offered, the fourth step is to accept the offer and sign the agreement. Funds will typically be deposited within 24 hours, though depending on the provider, it may take longer. Repayments will also depend on the provider and financing type, and may be on a weekly or monthly basis. For invoice factoring, you may not have to worry about making payments at all, as they usually collect directly from your client and then give you the rest of the advance, minus fees, once the invoices are paid. For even more information on invoice financing, check out the full guide on Finder, linked in the description box below. You'll also find guides on other types of business financing, including term loans, startup loans, low paperwork options, and more. If you found this video helpful, hit the like button, and don't forget to subscribe so you can be the first to know when new Finder videos drop.